Welcome to Tech Talk Tuesday. It's a short week this week due to Thanksgiving weekend. It's Tuesday, November 21st, 2023. My name is Carla, and with me today is your favorite CMT, David Blake. David, how are you doing this morning?
I'm doing well, Carla. Thank you very much. Thanks for asking.
Great. Well, let's jump right into it by taking a look at last week's stock market activity and what's ahead.
Okay, well, last week the major averages extended their weekly win streak to three. We had some cooling inflation numbers came in the form of the CPI on Tuesday. That's kind of sparked the call for the soft landing crowd to get excited about, and we had about a 500-point run in the Dow Jones, and we had interest rates pop down below the 4.5% level. If you remember, over the last month or two, once we saw the yield in the 10-year cross above 10% or cross above 4.5%, stocks have struggled with that level. So falling below that was big for the market, and we saw gains last week. The Dow was up about 660, almost 2%. I think the Nasdaq was actually up about 2.5%. And the small cap was up actually 5.4%. When you have lower rates, actually, it usually doesn't start until the Fed actually begins to cut. You'll have the small caps outperform the larger caps because once they usually don't take on more debt until they actually see the Federal Reserve actually begin to cut the interest rates. So, but they reacted on very positively last week with a 5.4% bounce. That was on top of about a 5 or 6% jump the week before. One of the things that we talk about on here, and especially in the market letter, is that we like to see the secondary indexes, which include the small cap Russell 2000, the Dow Jones Transports, and even the Philadelphia Semiconductor Index outperform or lead the market. In this case, all three of those for the last couple of weeks have been outperforming the big major averages, which is a plus. And we also had some strong earnings came out last week, especially on the retail end. We had Home Depot, Target, and Macy's. They all beat expectations. And then we also had some strong earnings from, say, Walmart and Cisco, Palo Alto Networks that beat estimates, but their guidance was a little bit iffy. And that caused those stocks to actually trade down. I know that some of those are actually trading up now that investors are kind of reevaluating some of those numbers. They've kind of had a little bit of a bounce here yesterday, and I think towards the end of the week there. So we also had a little bit of trouble with crude oil prices. They moved lower for a fourth consecutive week. A lot of that is on demand concerns from slower growth around the globe. And also we're getting increased production from non-OPEC countries, which include the United States, Venezuela. And I think there's a lot of Iranian oil getting onto the market now too. So that's helping keep prices down. We did see, I think Friday and yesterday, we are seeing oil prices back up to around 78. Looked like they were going to fall down below $70, but they stabilized down there, and they're starting to bounce up. So with the yield back below 4.5% on the 10-year and the 2-year T-bills under 5%, we're seeing prices firm here on the major averages, and looks like perhaps maybe we could see some follow through into December at this stage. Now, this week I mentioned in the Friday's letter that historically you do have an upward bias on Thanksgiving week. Generally, I think the market's up about 0.5%, and it's been up about 72% since about 1950. So as we started out the week yesterday, we did have a nice little pop there. But we're having a little bit of a pullback today, not much of one, but we're having some problems with a few retail stocks. Lowe's disappointed, and Best Buy disappointed a little bit. But on the other side, Dick's Sporting Goods actually they beat on all metrics, and they're kind of limiting some of the losses. Okay, as far as the technical condition of the market goes, it did improve last week. Like I said, we were able to race higher for a third consecutive week. the different technical indicators are in bullish ground. We had the MACD crossed over into positive territory, I think, about a week or so ago, and momentum is up around about 68, 69 yesterday. So we're getting close to being overbought by that metric. However, today I think we're seeing it maybe pull back a little bit. The level there is over 70, 72, something like that is where you'll start to see people talking about the market being overbought. So we're still in good shape. We had a couple sideways days last week, which I mentioned we're consolidation days. You have a big run over the last, I think we had the last 2 or 3 weeks. You need some time there for prices to consolidate before we could actually move a little bit higher. So I think that's what's going on right now. Off the October lows, when we bottomed out there around the 25th or whatever, October, the S&P 500 is up almost 10%. And the Nasdaq has jumped almost 12%. So we're seeing a strong rally. We're also seeing it across the board. I think every sector last week was positive. The sectors that led the market higher were, let's see, well, actually REITs jumped about 4.5% during that period. That was followed by 3% rallies in materials, consumer discretionary because of those retail earnings, and the utilities and financials. Financials are starting to outperform. We talked about that, I think it was last week, that they might be something you can start to nibble on, especially some of the regional banks that have been pretty much dead weight for a while. As the yield curve begins to flatten out, you'll start to see maybe some upgrades on these bank stocks. But you could look at KRE; it still pays a decent dividend, somewhere around 2.5%, 3%, which might be something that you could look at going forward, especially if we don't go into a recession, which they're hoping not to. We did see the small cap Russell 2000 stall right below its 200-day moving average. It stalled there again yesterday on this jump. The transports did cross over the 200-day moving average. That's good. And then the third secondary index we have, the semiconductors. It's close to punching a new high. It's getting up there to the point where we may see that break out the new highs soon. We also saw the major averages break above their September highs, which yesterday, and that kind of clears the way now for a run to probably the July highs that we saw from the summer rally. So I think that would be the next area where we could see some resistance to the different indexes. Hopefully we can cross that. Whether we'll get there by the end of the year, I don't know, but right now it looks good. Now, one thing I did want to mention, and we'll look at this in a little bit, is for the first time in a long time, we are actually seeing the equal weight S&P 500 outperform over the last 2 weeks, outperforming the NASDAQ 100, which is the symbol is QQQ, and that includes the Magnificent Seven. That's showing a broadening out of the market, which we want to see. You can't keep going on up forever with say 10, 15 stocks leading the market higher. So that's a good sign. We also had strong underlying breadth last week. The AD lines moved higher. They were kind of showing a little bit of negative divergence, which was troubling, but now we're starting them break above. They're reaching, I think, 3 or 4 week highs on the AD lines, which is a good sign. That means you have more stocks under accumulation than under distribution. So that's good. And the investor sentiment still remains bullish, but it's not overly bullish. You've had a big pickup in exposure by the hedge funds. They're up to 72.1%. That's the highest level since last August, when we got up to 78.5%. So the pros feel pretty good about this. And as far as the retail client goes, they're still bullish. In fact, they're about 43.8% bullish. That's up from just 24% 2 weeks ago. So the retail clients are starting to get on here after they saw as they're seeing a softening in inflation numbers, they're starting to come on board again. I think a lot of that also is I don't want to miss people if they say to themselves they don't want to miss a end of year rally if it's going to happen. So right now things look good. Like I said, I keep watching those. Once we cross the September highs yesterday, that's bullish for the market in general, and I think we probably are um, on track probably to begin to see a little bit more of a rally. I don't think it's going to be a real. Hey, I saw somebody, Jeremy Siegel or something like that from New York University, talking about a 8% rally by the end of the year. I don't see that. We still have to see November CPI and PPI come in, and the fact that the CPI came in pretty low, basically because we saw that slowdown coming in there. We saw that because of crude oil prices dropping, that really cuts down on your inflation number. Now that we're seeing oil prices go back up, that could be a little bit of a problem. We may see less progress on the inflation numbers at the end of November. So we'll kind of watch that. There were some mixed signals that we talked about with the different indicators after 2 weeks or so ago. That seems to be working its way. They're kind of falling behind us right now, and I think that as long as yields stay here under 4.5%, I think that we're probably going to see those different indexes move a little bit higher. And as I said in Friday's letter, we may get to see some early Santa sightings if rates can continue to stay here below this 4.5%. So at this stage, I think again looks like we're still consolidating some of these gains, but maybe we slow down a little bit and then we go sideways with an upward bias probably into December. Now people say, oh, what about a year-end rally? But when you talk about coming up off 10-12% from the October lows, you've already had a pretty good rally. So I would be looking more for from here, maybe 3-4-5% through the end of the year. I don't think we're going to see 8-10%, something like that. But things look pretty good right now, and I think we can sit in here and enjoy December and see higher prices.
Okay, so you mentioned that the technical condition of the market improved after last week's activity. However, I noticed that our MarketEdge CTI went down to a 1 off of a 2 the prior week. Can you elaborate why the CTI went down when the technical condition of the market actually improved?
Yeah, I'm glad you brought that up. Okay, the market posture is going to stay bullish. The CTI, the Cyclical Trend Index, based off Hearst's studies back in the 60s and 70s, it's a forecasting model. You have a forecasting model. You're looking, you project what you think is going to happen based on these cycles that have gone through the different to the market over years and years of studies. They seem to have different cycles that they'll follow: 40-day and 80-day and 18-week, 36-week, 18 months, 54-month, that type of thing. It's been a tough. These things, these markets change, and you're always going back and looking. Okay, well, maybe now it looks like maybe this was the bottom. Previously, it wasn't this week. It was 3 weeks earlier, or something like that. And even though the CTI went down, it actually would have gone to a negative number, but because rather than just rely on the CTI, that's why we include the momentum index and the sentiment index to make sure that we don't have just one indicator out there. We want confirmation from the momentum index that things are beginning to break down, or the sentiment index where it shows that things are getting too bullish or too bearish. Because a lot of times what will happen is you might see a positive number going on, and all of a sudden you'll start to see the momentum index go from a positive 5 or 6 down to a minus 3 or 4. Well, that's negative divergence, and that's something that as a technician you want to watch, and that's telling you that okay, even though the numbers are bullish, we're looking at probably the market beginning to go down here, or we've reached a peak on this cycle, and we're going to start heading down. So even though the CTI is going down, it means that some of the longer term cycles that we have, and by that I are including like the 36 weeks and the 72 weeks, they are exerting downward pressure on the different cycles. So that means that we're not, even though once we get a bottom on, say, the 18-week or the 80-day or the 40-day cycles, as they kick off to the upside, those longer term cycles, which are the dominant cycles, are still going to keep a lid on the bullish activity going on. And the way we have it right now, it looks like this market could probably bottom out. We may have more weakness after the first of the year, or maybe actually even towards the end of December. At that time period is when we have a lot of these different cycles once again bottoming out. Now, whether if we do go into a recession, that would be confirmation that these cycles are correct and pointing to why they're pointing to a negative market out a little bit further than the next couple of weeks. So again, we don't just rely on the one CTI model, since it's a forecasting model. We do need to have confirmation from the momentum index and the sentiment index. And in this case, they are not signaling that we're going down. They're actually showing that things still remain bullish at this stage. And because of that, we will keep the market posture bullish for now. I don't anticipate anything changing on that after this Friday either. Once we get into December, we'll, as long as the momentum index continues to be positive, and as long as my leaf blowers keep working outside, I think we could probably move higher.
All right. Well, yeah.
Carlo, but one last thing here. Let's go to the charts real quickly.
Okay.
I do want to show one thing here that I mentioned earlier in the talk. I want you to put up QQQ. Okay, as you can see, this I think QQQ is made up about 12 or 14%. This is through yesterday. You can see that bouncing off of the 200-day moving average there, and taking out actually the QQQs is actually taking out the July high already, which is that can be that's positive divergence, meaning that hopefully it'll lead the other indexes. Now let's compare that to the SPY. Okay, there you can see the SPY is going a little bit better. Let's change that to the what was it? RSP.
Oh.
RSP. Yeah. Now the RSP. This is the equal index on the S&P 500, and you can see over here how it's underperformed the QQQs for quite a long time. Probably over a year or so. Now let's go ahead and take this down to, say, to 10 days on the bottom. Okay, this is what I wanted you to see. That for the first time in months and months and months, starting here in early November, we're now starting to see the RSP outperform the QQQ. And that is what I mean. Now, instead of just having this leadership from the Magnificent Seven and the NASDAQ, now you're seeing a broadening out of this rally where you're including more stocks that are actually outperforming the Magnificent Seven, which is a bullish signal from here. You don't want to, like I said earlier, you don't want to just have 10 stocks leading the whole market higher. In this case, as you can see here, the equal weighted S&P 500 is now outperforming the NASDAQ 100, which is a bullish sign. That's a sign of positive divergence in that index, which if you put that up and put this in there and keep a look at that, as long as you see this thing outperforming, that's a bullish signal for the overall market, and that's probably something that you can keep in the back of your mind that says, I want to stay invested while I see this on the chart.
Okay, great. Well, that is all very helpful information, David. Is there anything else that you'd like to add before we head off to our Thanksgiving weekend?
No, I don't think so. Just the fact that I hope everyone knows how thankful and lucky we all are. When you look around the world events, just how lucky we are and fortunate we are that we live in the United States and we're all blessed to have, you know, to be in the kind of shape where we are right now. When you look at all the world events right now, things are a lot worse outside of this country than they are here. I hope everyone has a great Thanksgiving with family and friends.
Well, thank you for that, and I definitely respect that. And David, thank you again for all the great information to all our listeners. I also hope that you have a wonderful Thanksgiving holiday weekend. And that wraps up this week's for our Market Edge Tech Talk Tuesday. David, thank you again, as always, for all the great information, and you can catch us again next week.